January 15th this year will be the 14th anniversary of the miracle on the Hudson. Shortly after taking off from LaGuardia Airport, Captain Sully Sullenberger and co-pilot Jeff Skiles glided a powerless Airbus A320 to a safe landing on New York's Hudson River. By the way, it was Tom Hanks who plays Sully in the movie. Flight 1549 experienced a bird strike that shut down both engines. It's been described as the most successful ditching in aviation history, one that the press quickly dubbed the miracle on the Hudson. Today, the Federal Reserve is trying to do the same thing. Captain Powell is trying to engineer a soft landing of an economy quickly losing thrust and in danger of stalling. At this point, for the Fed to pull off any kind of soft landing, that would be a monetary miracle. Welcome to the Money Runner. I'm David Nelson. Inflation is still close to the highest levels in 40 years, showing few signs of easing. After last week's CPI report, markets are now pricing in a higher than expected terminal rate for Fed funds. The FOMC is expected to hike 75 basis points this week on Wednesday. Intellectual honesty doesn't come easy for Wall Street veterans, and the same goes for yours truly. After Jackson Hole and Jay Powell's hawkish commentary, the stock market's initial reaction started to price in a more accelerated path of rate hikes. At first, the bond market didn't confirm, showing little movement in Fed fund futures. In fact, 17 days later, the terminal rate had only risen 25 basis points to 3.78%. I really took that as a bullish signal, believing the futures market was correct and the retracement off the August highs in stocks was wrong. Well, the only thing wrong was my call. The stock market reaction to last Tuesday's CPI release was quick and severe. The broad markets put in their worst day since 2020, and for the week ended down just shy of 5%. I've been a general aviation pilot for most of my adult life, and I can tell you, when you find yourself off course, you better adjust quickly. No, it doesn't mean a wholesale set of changes, but at least an acceptance that your timeline is likely wrong, and you'll have to react to fresh incoming data. Being early on a call, yeah, you can do that. You can be early when it's a few days or even a few weeks, but anything more than that, you're just wrong. All right, now that I've confessed my sins, what's next? Well, the first is understanding that any chance of a soft landing with the Fed aggressively hiking rates and already visible cracks in the economy has about as much chance of succeeding as landing a 172,000-pound aircraft on a river with no power. It's possible, but it would take Top Gun-like skills to pull it off, and the history of this Fed isn't all that encouraging. We've been bouncing from one crisis to the next as the Fed was late to take off and will, as this author suggests, overcompensate in the other direction. No one is disputing the Fed needs to be aggressive, but the tools, they're blunt instruments. Steering the U.S. economy, it's like steering a battleship. The turn has to be made well in advance of the pivot point. Tuesday's core CPI and the trigger for Tuesday's carnage had several data points that monetary policy can address. This is where the Fed can do good work. Rents and food away from home were both hot, and all in, the 6.3% core rate was well above expectations. The Fed can and should deal with the demand side of inflation, but there's little they can do about supply. A higher Fed funds rate, that's not going to do anything to help resolve the supply shocks from the war in Ukraine or the worldwide impact from China's zero COVID policy. Milton Friedman, well, that's a name for the past. Milton Friedman, who received the Nobel Prize in Economic Sciences, once suggested the Federal Reserve System could be replaced by a computer. The computer would calculate month by month how much currency needed to be printed in order to achieve a steady rate of growth. No, it doesn't mean that there wouldn't be humans to oversee the system, but the history of this Federal Reserve is so ripe with failure, it's really hard to imagine that computers with some human oversight couldn't do a better job. With bubbles in a number of asset classes, the Fed was still buying bonds all the way until March of this year, at a time when its balance sheet was exploding with debt accumulated for more than a decade. Initially, yeah, there'd be some resistance from Fed officials, but eventually the doomsday calls would subside, especially if the plan was starting to work. Airline pilots, they had a similar reaction to autopilots fearing their jobs were at risk. That was probably 30, 40 years ago. The truth is, today, shortly after an airliner takes off to shortly before landing, most of the flight control work is done by computers. Today's pilot is a systems engineer, and the real role is to be there if and when computers fail. Today, some advanced airliners have autopilots so sophisticated they can fly the plane all the way to touchdown, capable of landing in what is known as zero-zero weather, zero ceiling and zero visibility. On Friday, I got to do something different. I moderated a panel at the Cornell Financial Engineering Manhattan and Rebellion Research Conference, The Future of Finance. On the panel were some of the brightest minds on the planet, including the chief strategist of an AI and machine learning shop, that's artificial intelligence, the global head of structured macro at a large international bank, a managing director at another bulge bracket investment bank, and finally, the former director of research of one of the most successful hedge funds ever. I asked all of them the following question: would we be better off with a Federal Reserve run by a computer? The answer from everyone was a resounding yes. If you like this podcast, please hit the subscribe button and don't forget to leave a comment. Good or bad, helps us get better. Thanks for joining. I'm David Nelson.